speaking of alternative assets, our next guest expanded the alternative asset portfolio from 100 million to more than 1 billion while he ran Duke's endowment. Brad Alford is the founder of Alpha Capital Management. It's an independent investment management firm based in Georgia, and he is running in part a fund of funds. But instead of being composed of hedge funds, actually mutual funds are the components. He is joining us now from our Atlanta newsroom. Brad, from one Crimson Tide fan that is a friend of mine, I was told to extend my sympathies to you about the game of the century. But that aside, we know you have a great business up and running, and your mission now essentially is to run this fund of funds as if it were run like ones that we all know, but with mutual funds instead. How is this going to bring less risk to the average investor?
Deirdre, thank you for allowing me to be on your show. You know, what we found out in 2008 as we were with our clients investing in hedge funds and LP structures when they were down 20 and 30%, that they really had a lot more risks than we thought they did. And we dealt with gates and lockups and some things that were very unpleasant with our clients. And so what we decided to do was to create our own two strategies and start managing those for our clients and using mutual funds. I mean, right now there are over 800 mutual funds, which Morningstar classifies as alternative mutual funds. So there's a plethora of funds to choose from. And we began running that in 2009, have been running it ever since.
And you've picked some all-stars from the mutual fund world. Jeff Gundlach is just one, Charles Duveau is another, so you have a pretty strong team.
It's an amazing amount of choices. There truly are. Just because you're not charging high fees like a LP hedge fund doesn't mean you're not talented. So with people like Jeffrey Gundlach and Charles Duval are fantastic. Eric Cinnamon at River Road is a fantastic group we use. So we have a great list. We have about 12 managers in each of our mutual funds, and they do a variety of different strategies.
So Brad, I want to ask you a somewhat obnoxious question. Did you do this because you don't think that hedge fund managers as a group are doing their job and that mutual funds, well, just quite frankly, can manage risk better?
It's a combination. That's a great question, Deirdre. The fees are so high, the returns just haven't recovered in 2009, 2010 for hedge funds, and clients are just frustrated with illiquidity, K1s, very high fees, and some of the blowups that have happened. They just get tired of the headline risk, and we just felt like there's a great deal of talents in the mutual fund world and alternatives. We're in very early innings of the growth of alternative mutual funds.
And I know that if for some reason a manager is not working out, you have a little bit more power, don't you, than the average fund of funds who's dealing with hedge funds as components?
That's certainly a pleasant change. As we say, that a change is a mouse click away. We have to be very careful because all of our managers are liquid every day. The two mutual funds we run are both liquid every day, so you can come in on a Monday and leave on a Tuesday, and it's very, very challenging to, you want your managers to have time to execute their strategy, and they go through rough patches. And so we've got to not terminate managers too quickly, and we spend a great deal of time looking at managers. Most of our managers have at least 5-year track records, if not 10.
And Brian, I just want to mention overall, I mean, this has been a pretty tough year no matter what kind of investing business you're in, which is part of why I assume you built a defensive fund.
The defensive is, just like it says, it's having a good year. It's still positive for the year. It's been a very crazy year, as everyone knows. Headline risk are every day with Europe, and I've been managing money for 22 years, and I don't think I've seen a more volatile year. It feels like 2008 again, and clients are scared, and so the defensive fund is doing what it's supposed to do.
It's doing what it's supposed to do. Brad, because we're on an alternative asset show, I'm just curious, how many investments, potential investments, are you considering from the PE world? I know that's probably not the bulk of your business, but I just want to ask.
Private equity, we tend to stay away from that. Most of our clients don't like the illiquidity of private equity. We have primarily high net worth clients at Duke. I did build a very large portfolio of about $600 million in private equity, but the only thing I'm doing now is buying secondaries, and even those prices have gotten trading closer to NAV and par, so we've gone away from buying secondaries for our clients.
Okay, Brad, sit tight. We're going to take a very quick break. We are going to be back with more from Brad Alford of Alpha Capital Management. He's going to be joining us again more about his strategy. Plus, we're with Brad Alford. He is the founder and CIO of Alpha Capital Management. Brad, thanks for staying with us. So before we took the quick break there, we were talking about hedge funds. How many are out there? About 10,000 of them. Is that too many?
Without a doubt. When I started first investing in hedge funds, actually before Duke, I was at the Emory Endowment here in Atlanta. And in the early 90s, there were hundreds. Now there's over 10,000. All the kids want to graduate business school and go work for a hedge fund as a quick rich quick strategy, and it's just been a dilution in talent, and there's just too many people doing the same trades, and it's unfortunate because it used to be such a unique asset class.
It used to be such a unique asset class, but you're saying that the performance is not what it could be, which is obviously why you have broken out and started this new kind of model, which is a fund of funds for mutual funds. The fees, I know, with the hedge funds, the more traditional LPs, is something that you also had almost a philosophical problem with, right?
Well, with hedge funds, they charge a performance fee of 20 to 30% or more. And in mutual funds, you can't charge a performance fee, so that's not on the table. So it's a very different type of fee schedule for mutual funds. It's just a much smaller fee level.
And Brad, just before we let you go, as far as the bigger ideas, as you say, you have 20 years of managing money experience. What is the biggest risk right now to the markets? Is it Europe? Is that what your mutual fund managers are talking about every day?
Without a doubt, it's Europe. Contagion. Everyone talks about it every day, every night. You know, you want to see how Europe opens up does in the morning. So it's driving the train right now. And until Europe gets its act together, then I don't think anyone's going to be feel very good about what's going on in the world, especially in equities.
And do you see that being, Brad? I mean, we've heard from most people, is not going to be resolved at least for a year as far as the reaction in the markets and the volatility. Do you agree with that?
Gosh, it's been well over a year, going on about to be 2 years, so I think it's going to be a long time, definitely into 2012, and who knows where it'll go from there if there is a breakup of the euro. We'll see.
All right, we'll see. Brad, thanks for joining us in the meantime. Brad Alford from Alpha Capital Management joining us there from our bureau in Atlanta. He runs a fund of funds, but instead of having the components be hedge funds, they are mutual funds, and you heard him say it here, they can actually provide just as good returns, but with less risk. We are going to take a quick break here on Money Moves. When we come back, a big bank is exiting the music business.